Putting together a high income portfolio can be a great way to generate passive income in retirement. In this video, we're going to look to putting together two portfolios, one active funds and one ETFs or passive funds. We're going to generate a yield of just over 6% that produces a portfolio that has relatively limited drama and drawdowns. For my passive portfolio, I've used the website justetf.com to help me construct it. I've done some filtering on firstly selecting equities through the ETF screener. I've selected those with a track record of 5 years or more and with a fund size larger than 100 million. In the columns, I've selected dividend yield and just sorted on that. So although I'll do some more research to find the ones most optimal for me for the purpose of this short video, I quite like the look of emerging markets dividend. That's got a high yield, not so great returns over 5 years, but that might change with good friend mean reversion. The stocks global select dividend 100, again a very high yield, that's worth looking at. Some USD high yield corporate bond debt, that might be quite interesting. Things like energy infrastructure is a bit specific around the energy markets. Brazil, I mean, I just prefer emerging markets as a whole. REITs, yeah, don't really like that one. So if we scroll down, we'll see some things like UK dividend as well, Asia Pacific dividend, and some European dividends. So we can use some of these ETFs to put together a blended portfolio. Put together a video where I look at how to use an ETF backtesting website. I'll put a link in the description. I've set up the income ETF portfolio within the excellent website curvo.eu so I can run a backtest and look at some stats on it. So we've got the portfolio here. I've just equal weighted it. We've got the performance over a period of, it's about 12 years. So reasonably stable, which is good. And it does grow. And we've got a growth rate of about 5.65%. We've got a Sharpe ratio 0.49, which isn't too bad. The annual returns, we had a bad year 2022, as did most funds, also 2020. 2018 again, most funds had a bad year then. With the impact of inflation, recently not done so well after inflation in terms of drawdown. Maximum drawdown was the COVID crash, although that was fairly short-lived. So now we've got some correlation data, which is quite useful. We can see which ETFs are highly correlated with each other. So the Global Select Dividend 100 seems to be quite correlated with things like Euro Stoxx Quality Dividend 50. And it also tracks the correlations over time. And you can see that some things have like a negative correlation and then a highly positive correlation. So that does kind of ebb and flow. But when putting together a portfolio, it's always useful to see which ETFs are really diversified by looking not at their holdings, but at how correlated they are. When putting together an income portfolio instead of a growth portfolio, I think there are pros and cons. The pros would be that it is ultimately incredibly passive. You just sit back and collect the cash, and you don't worry about any of the price movements of the underlying funds. The cons of this strategy are that dividend growth is not guaranteed, so your income is probably going to be eroded at least partially by inflation. An income portfolio generally underperforms a total return orientated portfolio. You could also end up with too little income prior to the state pension, which is £11,500 kicking in. So you've got to work out what you're going to do if you retire early. And then also you could end up with too much wealth later on in life because you're not drawing down on any of the capital. So you could end up with just too much money in your 80s and 90s. For the active fund portfolio, I've used the website Pick a Fund. I've filtered on a minimum yield criteria and a minimum net asset criteria. And now I'm searching on the 5-year performance. So at number 1, we've got BlackRock World Mining, which is currently a bit out of favor. That might be quite a good one to look at. FTF Clearbridge Global Infrastructure, that's one that I quite like as well. We've got Merchants Trust, that is a UK dividend hero, so it's an investment trust that has increased or maintained its dividend for the last 20 years, so that's really good. Schroeder ISF Global Dividend Maximizer, so this is a covered call fund where it's selling growth in equities in return for income, so it's getting a pretty decent yield and the net assets aren't too bad, so it's maybe not quite as flaky as some of the covered call operations that are out there. For an active bond fund, I've gone with Schroeder High Yield Opportunities. It's got a Morningstar 5-star performance rating and it's got some pretty decent performance, which is shown here. It's been going since 2000. It's got nearly 500 million under management. The yield is potentially nearly 8%. So I think it's quite a good addition to diversify an active portfolio. So here we've got both of the portfolios with the yields and the prices, and I'm going to use this file to track performance going forwards in terms of both capital growth and income received, and I'll make the file available to people who sign up for my mailing list. I'll put a link in the description. So I've equal weighted both portfolios. The active portfolio has one more fund in it. The yields are just over 6% for both of the portfolios. So let's see how they do going forwards. Do we have dividend cuts? Do we have declines in capital values? Or is this actually a very good way to earn passive income and enjoy your retirement? I found some data that looked at dividend yields and compared it to total returns. So here we've got a graph that looks at no dividend, a low dividend less than 2%, a medium dividend between 2 and 5%, and a high dividend of greater than 5%. And then we've got graphs of the total returns. So there's probably no surprises that the top line looks something like a NASDAQ chart and it's companies that have no dividend. And what happens in a lot of these companies is that they issue a lot of stock options to executives, and because the stock options wouldn't be eligible for any dividends anyway, all the executives care about is the share price going up. These companies often also engage in share buybacks, and that also helps to drive the prices higher, although in the future we've just got to be careful about mean reversion and whether this sort of growth is actually sustainable in the long term. So the bottom line, I expect it to be high dividend, but it's actually the medium dividend with a yield between 2% and 5%, and possibly the redeeming feature is that it's the least volatile, I think, of all the lines on the graph. So it looks like, using US data and using a period of low interest rates, that it is possible to have a high yield portfolio where you can just live off the dividend income, but then also get some capital growth. Putting together a portfolio of UK high dividend stocks can be time consuming and ultimately unrewarding. Here's some data from the website ukdividendstocks.com, where they're looking at the return of their portfolio and comparing it to the FTSE All Share. And over the last 4 years, they've underperformed each year. And I think that although patience is a virtue, there are often too many yield traps. And if you invest in individual companies, it's just too easy to come unstuck. So you're better off finding some funds and letting them take the strain. When putting together an income portfolio, I'm not so interested in its past performance, as I believe a yield opportunity will arise when dividends for companies are maintained, but but these companies become out of favor such that their price falls or stagnates, and then the yield increases. So these sorts of companies, I can be paid to be patient, collect a decent dividend, and hopefully they'll come back into favor. I also might get a higher margin of safety from these value opportunities if they're paying a decent return. This is the Vanguard FTSE All World High Dividend Yield ETF, VHYL. And we can notice two things about it. First of all is that the yield is below 4%. So if you're implying the 4% rule in retirement, you'd actually need more capital invested in an income strategy using this fund than you would having a global tracker and just taking 4% of the money every year. And then also that the dividend doesn't always grow, and it actually fell in 2023 compared to 2022. So with the income strategy, you've got that risk that you get lower money in nominal terms year on year. This is the ETF S&P Global Dividend Aristocrats, ticker GBDV. And here we can see the yield is over 4%, so that's good. There is still a yield decline in 2023. So even though the companies within this ETF have a good long-term track record of maintaining or increasing dividends, some of the companies within the ETF get kicked out, and then the ones that replace them have a lower dividend yield. And so because of this recycling, you can get cuts in the nominal dividend year on year. And part of the problem with this fund is that it does underperform a global tracker. So you would have always have been better off holding the global tracker and selling down part of it. If you want to learn how to research funds in more depth, then look at this video. I'll put a link in the description. How much money do you need to be paid in order to be not concerned about the capital growth of your portfolio? Well, ideally, you need to exceed the risk-free rate of return. And here's the highest return that I could find on a bank account, and it's with the rather dodgy name of Secure Trust Bank, and it's paying 5.1%. So really, I'd look for more than that from my yield portfolio. The reason being that I'm taking on risk with company dividends, as they could be cut or suspended altogether. So will income investors have a tough time ahead if returns of 5% are possible on savings accounts? Well, I think that's particularly true if the things they're investing in, such as actual real assets like property and infrastructure, have a lot of borrowing because there's a lot of uncertainty around interest rates in the future. And for this reason, I've selected only equity and bond funds for my income portfolio. Be careful with companies that are paying excessive dividends, because this means that they have less money to invest in research and development, in new products, in any sort of growth or diversification. They also have less money to invest in the brand and in the sales and marketing. Terry Smith once said that the ideal dividend is no dividend, providing the company has an abundance of high return opportunities that it can capitalize on. And I think the balance is somewhere in between these two. Let me know your comments on a dividend portfolio. Do you find it works for you? What are your favorite dividend funds? This video is part of a series which includes how to choose the best broker for you and how to research a specific fund in detail.